Jesse.
Here.
Ron.
Here.
Ken.
Here.
Harvey.
Here.
Rich. David. And Teresa. Okay. Let's have prayer.
Yes. If you all please bow our heads. Heavenly Father, we thank you so much, Lord, for the opportunity to come here, Lord, and serve our community. So much need here, and so thankful that you blessed this community here with an organization that can trust us with some assets to do some good. We also, Lord, ask that you please be with Rich and his family. They've got a situation with medical issues they're dealing with. We'll ask you to put your healing hand on Rich and his family in this time of need. Ask, Lord, that you also put some wisdom in us, Lord, and let us be mindful of the will you have for us so we can better our community. These we pray in your name. Amen.
Amen. Now we'll have public comment. Do we have any public comment? Okay, hearing none, we are just going to move on into the previous minutes. Has everyone had a chance to review them?
And I'd like to make a motion to accept the minutes as they are.
We have a motion. Do we have a second?
Second.
We have a second from Ron. All in favor?
Aye.
And this motion passes. Moving on into new business, Matt, we're going to let you go first, and then you'll be leaving us. Go back to the presentation. So go right ahead.
I appreciate the comments and letting me go first. It's my children's birthday, so it's my children's birthday, so I'll be in trouble at home if I don't get home pretty quickly. But sitting to my right here is one of our senior associates who's been working on Nathan for a few years as well. His name is Austin. He's going to sit through the rest of the meeting and provide input as needed for any budgetary items or financial questions. Okay, so included in the packet, beginning on page 9, are the financial statements through March of 2024. This is the halfway point of the fiscal year for the Marion County Hospital District. Like pretty much every prior month, the biggest mover on the balance sheets is the investment balance, which have continued to rise for the better part of 2024. Year-to-date, investment earnings are just a little over $34 million, and for the month of March, they were at $6.2 million worth of earnings. So again, that continues to be the biggest mover on the balance sheet. Once you get flipped back to these statements of revenues, expenses, and changes, net position, you'll see the income and expenses of the operations and the grants and funding for the hospital district for the month of March, as well as year-to-date. And then subsequent to that is the budget to actual, which shows the spending in line with budget items, which we're pleased to report. All spending has been in accordance with the budget, and we don't see any areas where we're going to be significantly budget. Any questions from the trustees? If not, we seek a motion.
We have a question, Joe. We need a motion for the approval of the finances.
Motion.
We have a motion. Do we have a second?
Second.
We have a second. All in favor?
Aye.
Motion passes. Thank you, Matt. Appreciate it. All right, Austin, you're on the hot seat. Moving on, we're going to move into investments. We have our friends here today. So, Evie, it's your show.
Okay, thank you.
You can adjust that up if you need to.
Okay, good evening. I guess I'll say first, my commentary is going to follow along with the brochure specific packet that you have. But first of all, good evening, everybody. It's really nice to be here in person for a change of pace. Today I'll kick off the investment part of the discussion with a brief market overview, and then I'll give you an idea of how the total fund has performed and where the assets stand before I turn it over to my colleagues here from Joe's Crescent and Greystone to delve into the detail of their various portfolio and transition plans. Before I get started, please do feel free to stop me at any time if you have questions, so I can make sure that we're all on the same page and we're all following along. So you can just start on the first page of materials, slide number 2. To cover some economic highlights, I'll recap what happened with GDP, interest rates, and inflation, since those are some of the key indicators of the economy's health and how markets might respond. So starting with GDP, real GDP produced another strong quarter to round out the end of 2023, coming in at about 3.4%. And we saw that consumer spending was strong again, and that was essentially the main economic driver throughout the last year. Private spending did weaken slightly, but it still showed modestly positive growth. And as we all know from reading the headlines, government spending was up pretty much throughout the year. So fast forward to late last week, the GDP reading for the first quarter of 2024 came in slightly weaker than expected at about 1.6%. But this was more so a function of net exports slowing down rather than consumer spending or anything like private investments. So that still leaves the Fed in a conundrum about what to do with interest rates, with inflation still running hotter than they'd like to see before feeling comfortable with cutting. And I mention that because that's going to be a common theme throughout performance and that we're going to talk a lot about because that's driving a lot of the uncertainty in today's market environment. So if we look then to interest rates, we saw that the Treasury yield curve rose across almost every maturity during the first quarter. And we know that the Fed hasn't changed rates since June of 2023. So, it's still a very hard environment to figure out what to do in terms of monetary policy. But we see them continuing to manage expectations. And during a recent speech, Fed Chair Jerome Powell said that the central bank is in no hurry to cut rates, and that it doesn't feel like we're in an economy that's suffering from the current level of interest rates. But markets are generally pricing in a lower probability of any rate cuts at all this year. To recap inflation, lastly, that remains stubborn. Consumer prices have moved higher recently after tapering down at the end of last year. So again, it's very confusing to figure out what to do with all of these mixed signals that are on. So taking all of this together, we can see how this translates to the market performance for the year. If we look to U.S. equities first, the stock market was up 10% for the first quarter of the year, and that brings the trailing 12-month return to 29.3%. And nearly every sector was positive, with the best sector, of course, being communication services. Again, that's something you're going to hear in terms of recurring theme throughout our talk tonight. And then the worst performing and only negative sector was real estate. Small cap underperformed large caps, while growth stocks generally outperformed value, and large cap growth stocks had a pretty massive advantage over large cap value for the trailing 12 months. And that 10% return that I'm talking about was the highest market concentration that we've seen in over 40 years, and that was dominated by NVIDIA. So that just goes to show a mark of the times that we're in very rich valuations that we're talking about. After seeing relatively more uniformity among the outperformance of the Magnificent Seven stocks that I remember vividly last October when we were all here, we talked a lot about, we've seen more fragmentation within the group as that AI theme has led to NVIDIA and then Meta to a lesser extent significantly outperforming for the quarter. If we look to non-US equities, the European economy was weak with consumers there more hesitant to spend, there were fewer exports going on, lower investment overall, and that reflects diminished economic demand. And then the outlook in China is improving due to stronger industrial activity and retail spending. If we look at fixed income and defensive assets, as I mentioned before, the yield curve is up nearly across the entire maturity spectrum, and expectations of a shallower rate cutting cycle does drive this rise that we've seen in bond yields taking place. So bringing it all together to discuss where we are today and how we're strategically positioning Marion County's portfolio for the road ahead, it's no secret that there's been a pretty dramatic reversal in market expectations in terms of what to expect for 2024, namely the path of monetary policy and when or if rate cuts will even happen. And as of today, markets are pricing in a much lower probability that the Fed will cut in June and a slightly higher probability that they might cut in September. But the recent rise in bond yields has seen the U.S. equity risk premium, which is essentially the additional return that you get for investing in equities over bonds, has shrunk to multi-decade lows that we've never seen. Depending on who you talk to, they'll tell you it's zero. Some people will even say that it's negative. So this backdrop that I'm talking about here has informed a great deal of the asset allocation work that we did together earlier this year, and we'll touch on that some more in just a few moments. But are there any questions before I move to start talking about the portfolio?
Anyone? I think you're good.
Okay. Touch on the portfolio positioning. Again, I'll keep my commentary at a total fund level, since we have the providers here with us to talk about their respective portfolios. We transitioned to a new policy on March 31st. So if we flip to page 6 of the Wilshire materials, you can see the aggregate positioning of the portfolio is on its way to being in line, for each asset class. Is that,
Page 6.
oh, okay, that's
Slide 6.
Sorry, yeah, slide 6,
It's not.
or 24, I think, of the packet.
There we go.
There we go, we're on the same page, okay. So yeah, we're on our way to being in line at the aggregate level. And, there are some asset classes that will take a little more time to get there, like I said. For example, diversifying marketable alts, some of the private assets, but, you'll see that come in line as we continue along that glide path. If we move to performance attribution for the first quarter on page 9, or 27, I think, of this one, we can see that the total, yep, that's the one, thank you. We can see that the total fund returned 4.61% versus the policy benchmark return of 4.33%. And these results bring the total portfolio value to just over $302 million as of the end of March, which is great. Most of this outperformance came from that orange bar that you're seeing on the right, which is manager value added or manager selection. And the majority of your active managers outside of the U.S. equity bucket outperformed their respective benchmarks. And as a reminder, the U.S. equity market is very narrow right now, so that's the kind of thing that you would expect to see with the Magnificent Seven continuing to lead the charge. And again, more performance details to follow from the providers. I want to give you an idea of what the aggregate performance looks like rolled up before we get there. The last couple of slides that I'm going to touch on, if you flip to, I think it's going to be page 32, we've included a little recap of the work that we've done since we last met in October. As you know, the main highlight is the approval of the new strategic IPS and the strategic asset allocation. And as I mentioned earlier, these changes have really been prompted by our long-term capital market forecast now reflecting an environment where there are more opportunities to reduce risk and diversify the drivers of the different sources of return in your portfolio outside of just public equities in this market environment. And we think that these changes are going to be beneficial and they'll ultimately make the portfolio more robust and resilient through various market cycles. And we've discussed our plan and the glide path to transition to the new portfolio by the third quarter of 2026, hopefully. And today we'll delve deeper into the details for the plan of how we're going to get there. So on page 15, which is the last slide I will review, we've placed a red box around the current interim target as of March 31st, which is our first major transition in milestone in the transition plan. And now I'll turn it over to Truist first, then Crescent and Greystone to talk about first performance attribution for their portfolio, and then to their respective portfolio status versus the new targets and the go-forward transition plans that we've been talking about. Before I get off, any questions for me?
I did have one. I did have one question. I think on one of the asset classes that we just recently added, that was currently behind our target, but I think I heard you say earlier that's because we're in the process of transitioning, and that's supposed to really take place in March of 2026.
Okay, so the glide path that we've set out, we have different milestones. So for example, you can see this first one, like where the red box is, U.S. public equities, for example, should be within range because that's theoretically the most liquid portion of the portfolio, right? And then as you can see us getting out toward the third quarter of 2026, some of the less liquid asset classes like private credit, private real assets, that's when we expect those portions to be more in line with target.
So slide 15.
Yes, slide 15 shows you where we should be relative to the policy benchmark as we're measuring it as of the end of March. But realistically, there will be some frictions. It won't all perfectly align with the plan. Hopefully by the third quarter of 2026, so end of September 2026, we should be there.
Thank you.
Anyone else? Okay, thank you.
Good afternoon. Great to see some of you for the first time, and
and many of you again. It's been a lot of fun and a lot of work working with EP and Nathan and the team at Wilshire, but I think we're making great progress. Spend just a little bit of time, I don't know if you have our presentation, what the plan is, but I'll just kind of reference page numbers if you have a copy. So let's start in the presentation. Yes?
Why don't you tell them who you are?
Oh, sorry, for those of you who don't know me, I'm Mike Hill, and I'm Managing Director at Truist, and have had the honor of working with this portfolio, this pool of assets since inception. So it's been a great journey. We've learned a lot together. Portfolio's grown significantly, and very excited for this next iteration of the portfolio, because it will look different. Return streams will be different. There will be some new investments, new investment types in the portfolio that we haven't invested in together before. So ask questions. Some of this will be brand new, some of this will be old hat. But what I've learned doing this for over 30 years, the better we communicate, the better the outcome is going to be for the portfolio. So stop me as you have questions.
Thanks.
Thank you. You bet. If you're following along in our presentation, let's start on page 4, and the page numbers are small, bottom right corner, just to acquaint you with the overall portfolio. So as of March 31st, market value $98,406,730. And then I'll hit the big kind of asset class level allocations and look at that relative to policy and the new ranges, because we are transitioning. Right? This will take a little bit of time. So 40% of the portfolio is in U.S. equities. That's the good news, because U.S. equities had a great 2023 and a strong start to 2024. Non-U.S. equities make up about 10% of the portfolio. Private equity, we're about 3.5% of the portfolio. We have some work to do there together. What we're now calling directional marketable. So kind of think about equity long short. We have 3 strategies there that make up 7.5% of the portfolio. Core fixed income, it's about a third of the portfolio. And uniquely within fixed income right now, we have a strategy in place that's working very well relative to the benchmark. And your benchmark is the Bloomberg Barclays aggregate. And there's a lot of volatility in bonds for exactly what you just said. A lot of consternation about what the Fed's going to do with interest rates. So we have what we call a barbell in place. About half of the fixed income portfolio is allocated to 1 to 3 month T-bills, right? So when interest rates are going up, the total return part of fixed income is going down. This is serving as a nice offset. So we really navigated over the last 18 months the fixed income market well. De minimis cash, it's down to 2.5%, but it's earning 5.2%. Right, so that's nice, that's new, first time in a long time. And then to round this out, diversifying marketable. What does that mean? That means diversifying strategies that are not long-only equity or long-only bonds, but trade with a ticker every day. So not 90-day, 180-day liquidity, but everyday liquidity. And there are some pluses and minuses that come with that. So as you look at page 4, the far right-hand column, try to keep this easy, red and green. If it's red, we're outside of policy. We're working to get into the new policy. If it's green, we're inside of policy. Before we look at performance, any questions about asset allocation or where we are headed? All right, page 6, bottom right. So strong first quarter. It was an equity, U.S. equity driven quarter, largely, up a little over 4.5%. Large cap equities were 10.5%. And as EP mentioned, mid cap, small cap didn't perform as well, but on an absolute basis, 8%, very, very strong 1 quarter return for small and mid cap stocks, but just relative to large cap underperformed a little bit. In the U.S., we are tilted toward growth relative to value. That's important because there's more tech and growth. Growth has been outperforming because tech has been outperforming. We think, based on the outlook for 2024, that continues to persist the remainder of this year. The exact opposite is happening internationally. We were big tech stocks internationally, so if you see the non-US equity allocation, it's reversed. We're overweight value, underweight growth, getting that same level of outperformance because value is outperforming growth. Private equity, we don't yet have the numbers because private equity reports with a lag, but in a couple of pages I'll show you where we are in private equity. We're up in the 20% net IRRs from a return standpoint. We've got some vintage year investment to catch up on. We need to be sure that we get it on 2024, but we'll work with you on that. Turning to page 7, and I'm going to round this out. Currently, no private credit exposure in the portfolio. That's coming. Directional, marketable alternatives. So think about your equity long-short strategies. For the quarter, up about 3%. Core fixed income, essentially flat. But as I mentioned, compared to the ag, which was down 78 basis points, doing exactly what we intended for it to do. Cash, as I said, has about a 5.2% yield, so that's right in line with the 1-quarter return. And then lastly, for diversifying marketable alternatives, also up about 3%. So you get a sense, again, for just the wide relative range of returns. It has been now for some time an equity-driven market, particularly a large-cap domestic equity-driven market. That's where we have the most of our exposure in the portfolio. I'll push pause there and turn over a couple of pages, and we'll wrap up with 2 more slides. And again, as you have questions, let me know. Page 12, again, page number, bottom right-hand corner. This is the private equity summary, so it's on a table. The top table demonstrates performance through September. Again, private equity reports with a lag, so we do not yet have year-end numbers. We do have year-end commitment values, though. So on the top table, far right column, you see the net annualized IRR, internal rate of return, for your private equity program, 21.02%. So fantastic returns for private equity. As of March 31st, the fund, our portion of the fund, has committed $4 million to private equity. $2.9 million has been called. So about 73% of the $4 million has been called and put to work. So that's right on track with what we expect from this manager. About 18 months to get the capital fully working in the portfolio. And then lastly, page 13, transition plan, showing where we are currently as of March 31st, and our roadmap heading into the end of calendar year 2024. So we'll continue to use the market opportunistically to make some shifts out of the traditional asset classes, the public asset classes, and then we're making the subscription investments into those longer dated investments on behalf of Marion County. Any questions that I can answer for anyone about performance, the portfolio, outlook, or otherwise?
I don't have any.
We used to have standard benchmark comparisons before. We took that away, or?
Say that, can you say that one more time?
Benchmark comparisons we used to have based on these performances. We always had one, you remember? Is there any reason we don't do it anymore?
Yeah, I think we do.
We do.
You mentioned that. There is a, is it called a policy benchmark now, or strategic?
Yeah, the new policy benchmark.
It's a policy benchmark, and it was in the information that Wilshire demonstrated. So looking at total portfolio performance versus that benchmark. So that was there. And I also included benchmark, if you go back to page 6 in the presentation, And if you look at the quarter-to-date column, the strategic benchmark, it's footnoted on the bottom of page 7. But as that comparison, the strategic benchmark return was 4.42% for the quarter ending March 31st, 24.
It's just not in the same format that you were used to looking at. And each provider is doing it separately as opposed to a regular sheet, but you
Yes,
have a three.
but Melissa brings
We
it
have
to
the
the table.
total fund, the chart that I've shown you, the different bars, will show you how the total fund performance was versus the annual policy benchmark, and then they each break it out by their own portfolios.
Other questions for Mike? Mike, thank you so much.
Thank you.
Pleasure to see you.
Very cool.
Thank you for
Thanks.
coming.
We next?
Who's next?
Question Capital's next. Everybody, Martin and Alex, great to see everybody again. So we've sent you a packet, everything, it's the orange covered page. So the performance reports are typical performance report. We've added a trailing 6-month performance number just to include the time frame since we last met in person. And then while the strategic benchmark through March is still the same, we've updated the allocation targets and policy page, which is I think pages 3 and 4 of the performance report, to include new investment policy targets and asset class descriptions. And we'll touch on that later during the start performance. But rather than going through that performance report with each of those line items, we created a performance addendum. So there's a tab at the bottom, maybe the second last tab, that kind of provides a high-level summary of what's been going on with the portfolio. So if we look at it for March, we were up about 2.05%, beating the benchmark by about 10 basis points. And most of that was driven by the outperformance of the liquid alts, where you see they were up roughly 3% versus the benchmark being up about 1.6. And to a lesser extent, we outperformed slightly on U.S. equity by about 7 basis points. And then we were a little bit underweight on fixed income, which helped because fixed income lagged the rest of the asset classes except cash. And then for the first quarter, portfolio is up about 5.3, outperforming the benchmark by nearly 1%. U.S. equities are lagging by about 0.5%, still up about 10%. Most of that's because of the small caps that are embedded within that total market ETF, and there are slight drag in returns. On the international equity side, we outperformed by about 70 basis points, and that's largely due to GQG, it's an emerging market fund we initiated in October. It was up about 10% in the first quarter, and FundSmith was up about 8% in the first quarter, so both of them outperformed significantly versus their benchmarks. Liquid alts have been very additive again, jumping nearly 10%, beating that benchmark by about 5.7% year to date, and most of that was driven by our equity long short managers that were all up about 12 to 13%. Our BTC performance, our fund, Caladine's up roughly 7% in the quarter, so still not a bad return there. On the fixed income side, we're outperforming by roughly 60 basis points. A lot of that is because we have a lower duration than the rest of the market, and that's intentional. We want to have a little bit less duration right now because of rates going higher. And then for the last 6 months, so if you click to slide 2, the performance update, portfolio is up about 14% since we last met 6 months ago, and outperforming the benchmark by about 1.4. The liquid alts again are taking center stage, posting a return of nearly 17 or nearly 18%, and outperforming their benchmark by about 10%. Again, equity long short managers doing really well, up over 20% across the board. U.S. equity is led by about 0.25%, and that's with a small cap tilt that we've in place through Polar Thaler's behavioral mutual fund, and again nearly 28%. International equities led by nearly 1%. Again, it's emerging markets that we initiated in October. They were up about 20% combined, and FundSmith delivered some outperformance. And then for the year, we're up over 15%, leading the benchmark by roughly 2.25. Again, liquid alts, that's the equity long shorts managers, doing exceptionally well, jumping nearly 25% and outperforming the benchmark by over 15%. U.S. equities gained nearly 30% and only slightly lagged the benchmark because of that narrow market focus. International equities gained about 12%, lagged the benchmark by about 2%, and most of that drag was from an Aberdeen emerging markets fund that we sold out of in October to position in that GQG fund that's done really well. And the rest of the underperformance was pretty much Fundsmith and Smithson, which struggled in the second and third quarters of last year. And then fixed income peaked out at a 2.8% return, beat the benchmark by a little over 1%, and again, it's the lower duration profile that's like that. Any questions on performance?
Anyone?
And the strategic benchmark is listed on our page. I think it's page 2 of the performance report. It's at the bottom. It's footnoted, so you'll see. So going forward would be the new policy benchmark set forth by Wilshire. So next, we're going to talk about the portfolio transition. So I think there's a tab called portfolio transition. It's the final tab in the packet. So this kind of shows how the asset reclassification, how everything's getting mapped over. So equities are going to be mapped over as growth assets, and you may see that it looks like a huge jump in growth by about 7%. That's because private equity is getting lumped into growth assets now. So we have some private equity managers, as well as Caladine's BDC income. Previously it was a liquid alt, but because it's more growthy in its equity investments and business development companies, we felt that that should be part of the growth sector rather than one of these other sectors like defensive growth or private credit. The alternatives are mapping over pretty much as defensive growth assets. It's the private credit funds that we have, Kane Anderson's senior credit funds, your capital commercial real estate, and we initiated a position in the Cliffwater Corporate Lending Fund. And then the directional alternatives include the equity long-short managers that have done so well. It's Valua, BlackRock, SEG. And then public fixed income and cash are just going to map over as the defensive assets. And then we have a couple new categories, real assets, and then diversifying alts, which we previously did not have exposure to. So if you look at page 3 of the transition roadmap, same section, you'll see we've highlighted a couple areas where we're out of tolerance, out of range right now, and that's within U.S. Within non-U.S. equities, we're at about 12.5%. We redeemed $3 million from the Fundsmith equity fund, which actually came through on April 5th. So there's $3 million less in international equity, so it's actually really within policy weight now. And then we're also redeeming, fully redeeming Smithson with proceeds of about $1.2 million expected sometime in June. And then within private credit, we initiated a $1.25 million position in the Cliffwater Corporate Lending Fund, and since the allocation target's going to be rising over time, we were okay being a little bit overweight and just being a little bit early on that. And then within diversifying marketable alts, we initiated a $1.5 million position in Blackstone's Alternative Multi-Strategy Fund, which provides a really diverse set of hedge funds and alternative strategies managed by Blackstone. It's a 40-Act mutual fund, so it's daily liquid. We can get in and out of it anytime we see fit. And then in the coming quarters, we'll continue working towards those allocations, and we'll be within range, hopefully by December 31st, at least within those targets. And the looks and the timing of that will be influenced by market conditions and the opportunity set that we see. Within U.S. equities, so we're a little bit overweight right now, but we'll continue trimming in a systemic and orderly fashion. We sold over $3 million in March, and that all came from the total market ETF, basically because large caps have done so well. We wanted to de-emphasize them a little bit, and so we took it out of that total market ETF. And then non-U.S. equity, as I mentioned, we redeemed $3 million from Fundsmith. Likely are going to be redeeming the full position at some point this year. We just want to do it in a systematic, orderly fashion, not just rip the Band-Aid and just make a knee-jerk reaction decision. And once Smithson and then Fundsmith redeem will probably be around 6%, right around policy weight. And then in private equity, we're planning to initiate a position in Partners Group, private equity, and we'll continue evaluating other opportunities. Partners Group provides instant diversification by sector, by style, by finish, Basically, it's going to provide broad exposure to private markets and hopefully protect us on the bond side. And then the private credit space will likely continue adding to Cliffwater's corporate lending fund. Cliffwater provides immediate access to about 20 plus lenders, and they make loans that are about 95% first lien exposure, and that have loans out to roughly 4,000 middle market companies, and the yields on them are roughly 10 to 12%, so a strong yielding fund. And then in directional marketable alts, that's where equity long short managers lie. They've done exceptionally well. We're a little bit overweight or towards the top end of the range. We're going to keep it that way. Probably ultimately liquidate a little bit from each one, try to get about an equal weight position, and probably be at the top end of the range at about 5%. And then in core fixed income, we're in range, and we're going to continue focusing on active management there. And public real assets will likely be near the low end of the target range, probably around 2%, since commodities typically do their best when inflation is rising, and that's what the Fed is exactly trying to fight, is that rising inflation. So we don't really want to be in that position where we're fighting the Fed. And then in diversified marketable alts, we're planning to initiate a couple more positions, one with a market neutral hedge fund, and then another one with a special situations hedge fund. Both of them provide great downside protection, so that's the plan, to continue to diversify.
I have a question,
Yeah.
and you probably just need to correct me, I misunderstood. Directional marketable alternatives, you said that you're going to be probably in the higher range at 5?
Yeah.
Okay, is that what you're anticipating by the end of 24?
Yes.
So, but your range on your target says 2.5, right?
So the target is 2.5, but the range is 1 to 5. So
Okay,
yeah,
so
we're
you're gonna be high- you're just
yeah,
gonna
we're
be
going to
high.
be on that high end because we really like those managers. They've done so well, and we think they
I
have.
thought I heard you say target at 5.
Oh, yeah, sorry.
Okay,
Total
that's
time
what we
range.
need. Okay. Questions?
Any other questions?
Thank you very
No
much.
worries.
All right, Adam. And TJ.
TJ, you can come up with
Never
me,
forget
yeah. Good afternoon. Thanks, everyone. I'm Adam Palmer, Managing Partner, Managing Director of Greystone Consulting in Tampa, with TJ Lowe, my colleague. So we just have 5 or 6 pages to go through, a high-level summary. We've also had a good working relationship with Wilshire, Efi, and Nathan. Very responsive, good flow back and forth, and we do appreciate all the work that they and all of you have done making the decisions on the new target allocation, updating the investment policy, et cetera. So we'll start on our packet, page 5, and this is a high-level summary of the performance of the portfolio. Then TJ's going to get into a few of the manager decisions, highlight a couple managers' performance, and then we just have a quick update on our transition. We're unique in the sense that, you know, we inherited some of the liquids that have a schedule of when they can be liquidated, and we had that schedule for you just to manage the expectations for us in the transition. But we do feel very good of the transition we've done so far as of March 31st of this year. So on page 5, if you look in our book, the top has the chart there that shows the 1-month, quarter, 6-month, 1-year return on a graph. Right below that is the manager annualized performance. So we can highlight the 1 month. The performance of the portfolio for 1 month is up 189, a little bit higher than the benchmark for 1 month. Quarter to date sits right on top of the benchmark. Of course, in our world, when you match the benchmark, it makes me say, are we sure that that's accurate? Let's double check that. It is, so we're exactly on the benchmark. But when you go to the 6 months, slightly behind, 1147 over that 6-month return since the last time we met versus 1227 on the policy benchmark. But since inception, we have some outperformance. So the fund, since we've been taking it over October 1st of 2021, so still not that long of a time frame, but up 4.3% versus the benchmark up 3.01, so better by 1.29%. If we look just below that on the historic asset growth, I mean, being a nonprofit myself, I mean, what is very important for a large fund and doing the special work that all of you do is you keep up with the spend. You know, the fund continues to grow, you're making a difference in the community. If you look at that 6 month there under historic asset growth, you'll see 6 months ago we were at 96,035,000. Net contributions, withdrawals, the minus 1,470,000. Fees and expenses, $75,000, that would be our consulting fee plus all of your manager fees combined. And then a gain of just under 11 million, 10,920,000 to finish at 105,410,000. If we just look at the since inception column, similar flow. When we first were hired, we were at 102,517,000. We've had net contributions, withdrawals of 7,107,000, fees and expenses of 520,000. Again, our fee plus all the manager fees, and then a gain of that 10,519,000 to finish at that same number. The last two lines, as you know from the past, we like to highlight those. So it shows what the total fund return has been, 4.3 versus its policy benchmark 301. Standard deviation is that measurement of volatility or risk, so the portfolio is taking less risk than the benchmark, which is our goal. The maximum drawdown since we were hired, down 13.11%. That would have been sometime in 2022 when equities and fixed income were all selling off. But if you look at our benchmark, down quite a bit more, down 17.08. So we tend to build portfolios that may not be up as much when the market is going straight up, but we sure hope they're not down as much when the market has a tough year. That would show you right there, down 13.11 versus down 17 for the benchmark. We're capturing so far just under 100 of the up in the market, so 98.12, and then 89.26% of the down. So that's a positive alpha. Just means that our managers are adding value when you adjust for risk versus just being in a ETF or an S&P 500 fund or something like that. So I'll turn it over to TJ and then I'll be back.
When we look at performance and take a look at page 6, everything you're going to see rhymes with what you heard from the other two providers. We had a very limited return set, especially in U.S. markets. It is tough to outperform. But if you're on page 6 and we're looking at U.S. equities, up 357 for the 1 month, up 10% versus 9.95. So some positive attributions in U.S. As we've seen the market now bifurcate, you've seen the Magnificent Seven, now we call the Fab Four. As the market's starting to disperse, we are starting to see strong returns. But out of the 6 active managers, 4 are outperforming. Highlighting a few, we have JP Morgan, large cap growth. About second manager from the bottom of that page. A growth manager is outperforming for all time periods. That's unusual. They're price momentum, they're a momentum manager, so as the market's taken off, they participated in that up market. But to Adam's point, we also want to protect on the downside. If you look at Brown, a little bit behind. But as the market would sell off, we would expect that manager to outperform. So we marry those two, and as we've seen this market start to turn, we're seeing positive results in the U.S. equity space. A little bit behind since inception, but real strong performance for last quarter, and as we go to the next quarter, we expect that as well. In non-U.S. equities on page 7, for the quarter up 593 versus benchmark at 433. Over the last year up 18% versus 13%, up 147 since inception. Similar to another manager, we do have GQG, Emerging Markets, been a strong manager since inception, up 13.5, where the benchmark's up 1%. We've been overweight emerging markets a little bit over the last several years. We've been cutting that back. At the end of March, we did, when we had the chance to rebalance, take a little bit of that off the table, sell high, buy low. So we took a little bit of that off the table. We're seeing strong performance in non-U.S. equities. And then if we turn the page, where's the lag then the last year? Private equities. And Adam alluded to it a little bit on the front end. You know, we've been handcuffed a little bit, and we'll touch on the timeline of how this is going to unroll and how we're going to get back into compliance on the next several pages. But if we look over the last 12 months, even the 6-month return is negative for our private equity managers. We're seeing them reprice, as 2022 was a tough year for public equities. Our private equity managers have repriced over the last 12 months. We did see a print for the first quarter for 2 of the managers, and we do have some positive results coming into 2024. That's what we hope to see continuing. But Signia, for example, they're still in a capital drawdown structure. We just haven't seen them sell assets, haven't seen the positive results. So we'd expect that to come and see positive results. But that has been a drag on the portfolio for the last year. Private credit has been positive, a good attribute. Golub's up almost 9.5 since inception, versus 2 on the benchmark. We expect them to liquidate here in the middle of this year, and then we'll take another private equity or private credit manager at that point. If we go to page 9, fixed income, outperformed over the last 6 months, a little bit behind over the last year, but back to inception. We've been shorter duration, higher quality. We've outperformed 3% versus 367 for the benchmark in a down market. We're starting to see duration come up in anticipation of rates coming down in the future. So some of our managers, BlackRock was equal for the quarter, Double Line a little bit behind, and also NatWest, as in anticipation of rates being cut at some point, they've increased duration. To wrap up, performance, page 10, this is where we've made the biggest changes so far. We've added the public real assets. We've come to benchmark weight. We're not overweighting, we're not underweighting at this point with just the transition. We've made the decision, let's get right on top of our targets. And then we have private real assets at the bottom of the page, premium private real estate fund. We're going to touch on that in a little bit, but that's an outlier. You look at 45% return. We're blessed, I guess, to come in at the right time when they started liquidating some of their assets. They priced them up, so there was a big bump right when we started to report on that asset. So overall, good performance as we're starting to see the market, get some more volatility. The Fab 7, the Magnificent 7 coming to the Fab 4. We're seeing really good positive attributes to the portfolio. Any questions on performance before we go through the transition and where we are and some anticipated changes coming in the next 18 months?
Continue.
Okay, just a couple more pages. On page 12, we did a little write-up on where we are in transition. This is just a good, you can read it. So we started the transition to the new investment policy statement targets in late March. Here's some of the highlighted changes. We funded the public real assets to target by reducing the exposure to U.S. and non-U.S. equities. Evie actually touched on that. U.S. markets, publicly traded securities, really easy to bring that down from 40 to the 30 range. So that was an easy trade to make. We are overweight cash in anticipating the investing in some of the directional marketable alternatives and diversifying. I think there's some paperwork with the group that's being reviewed by legal that we need signed before we can invest. TJ is more up to speed on the timing of that. But I know that we have some new investments we want to get that's in review with the group for us to go ahead and execute on. And then, as stated, we're overweight the private real assets. Premium originally told us that they thought they'd be liquidating sometime in 2024. We had a call with them, now they're looking at sometime in 2025. So that's out of our control. I think they probably looked at maybe some real mark-to-market values of their portfolio. Maybe they want to delay it a year, we'll see. And then if you just look there's the funds that we're waiting on, and we have the anticipated liquidation dates there. So GALA, mid-24, Premium Private Real Estate, mid-25, the PAS Fund 2027, Trinity's won't be till 2028. And then to TJ's point, Signia is still calling capital up. So that's 10 years from now. That's going to be some time. And then we do have just details on the next page that shows where we are over and underweight. And I'll let TJ close.
The good and bad news is we are waiting on that premium to get back into full compliance. And that liquidation was pushed out another year as they're seeing the real estate market soften a little bit, that they're not getting the prices they wanted. So they had the option to do it, and they decided to take that option. But if we look at everything else on page 13, we're within compliance except for what Adam touched on. We're waiting for a little bit of paperwork to come back. So we'll be on our way to those targets. We'll be able to come on the low end of the range on most of these until we liquidate premium. So that's going to be the one that over the next 18 months will get us fully back into compliance.
Questions? Thank you all. That was very much.
Thank you very much.
Do you have anything you want to conclude with? Okay. Okay. Hearing none, thank you all very much.
Thank you.
Thank you.
Thank you.
Thank you. All right, we're going to move on to operations. Mr. Resky.
Thank you, Madam Chair. Just to put us that
last board meeting, we disclosed, didn't we, the insurance premiums as well as all the different liability insurance we carry. Staff has been so kind now to include also the deductible amounts on there. Where I'd like to go with this is, one is to, if I could, Madam Chair, I have the board acknowledge the sheet of this. But secondly, we are going to be in the midst of meeting with the consultant to find out what we think is the most appropriate levels of insurance, particular liability for this organization. So should be coming back here next board meeting again with some more discussion as well as perhaps even some action on to establish a policy, shall I say, for minimum insurance amounts that we need to maintain in this organization as it relates to liability. So again, I'd ask you to take a look at that. And else, if you have any comments, please can't let me know, but you can let Deborah Kirk know. Yeah, the other thing is on the balance scorecard, and I'm going to ask Deborah Kirk if you go to the balance scorecard.
So, the balance scorecard is in the packet for review. Hopefully you all have the opportunity to review it. Everything that, all of our targets, they're either in progress and we don't see any barriers or meeting those targets, or we are exceeding those goals. So one of the things that I wanted to say, instead of going through each and every one of these areas, is if you guys individually want to contact me, and if you have any questions about that, then I will be more than happy to sit down, come visit you, and go over it. Does anybody have any questions about the balance scorecard? No? Okay.
Thank you. Y'all can read it if you have questions. In the agenda, it does list operations manual updates, but that is an error. We do not have that unless you do.
I think you were just going to go and update on where
We
we are
were
with it.
discussing changes to the operations manual.
Oh, yeah, sorry, yeah, yes. Just, Madam Chair, we'll be coming back. We are in discussion at committee level on continued changes to our operations manual. I hope to have that finalized here for our next board meeting. That's an ongoing process.
And thank you for taking that on. Okay, anything else for operations?
Amen.
All right, thank you, Rick. Moving into legal. All right.
So, if it's okay, I'll take the first one.
And as we've stated on the record, I'm conflicted down on the MOU matter for the conference.
Exactly. So, we've been working with our alternate attorney, Chris Cervalera, and he's been providing us with potential wording for the MOU regarding the naming rights that the board voted on previously to provide to relinquish our rights to the College of Central Florida so they could secure a irrevocable pledge from a single donor, Advent Health. And at the time, we said we estimated that it would be $3,500,000 for those naming rights. This is more of an FYI. Advent Health is in discussions with Advent Health Corporate is in discussions with the College of Central Florida on the final wording regarding what that naming rights language will look like. One thing that Dr. Henderson brought to my attention was the discussions from the beginning between Advent Health and the College of Central Florida were that whatever dollar amount is decided on, $3,500 or more, that would be paid out as an irrevocable pledge over the course of 5 years. It wouldn't be lump sum. $3,500,000.
Okay, you said 3,500 a month, that's pretty cheap.
3.5 million, that's a lot easier to say. Tongue twister today.
But I thought you said 4 million first, they changed it.
So it was 20% of the value of the building. They just didn't have a finalized value because the construction's not complete. So they're getting finalized numbers. Typically, the College of Central Florida, in order to, for an organization to have naming rights, the standard fee is 20% of the cost of that building. And that would be between 3.5 million and 4 million.
So we changed from the lump sum to a distribution over a 5-year period.
That's what they're asking, that's what their negotiation is.
And how is the distribution going to be, over 5 years?
I don't know that part yet. They haven't finalized. But once they have their proposed language, then I'll bring it back to the board for final change to the MOU, hopefully. We should have that by the next meeting.
Alrighty. Matt?
Yes, and as it relates to the ongoing Stark Law disclosures that we made to CMS, we received confirmation from CMS on April 15th. They've begun to process the settlement. We're expected to receive a response in approximately 30 to 60 days, so at some point in mid-May to mid-June from CMS. That will be in the form of a settlement letter, which will then, now I spoke with Mr. Kaplitsky. There is a chance that they will pose some questions to us. He believes it's very unlikely in his experience, just because of the nature of these Stark Law violations, that there's nothing intentional going on. It's all either mistaken or accidental, in which case CMS does not typically ask clarifying questions. But we should hear a response from them in the form of a settlement letter between mid-May and mid-June, at which point, like we discussed previously, we expect that number to be somewhere between $75,000 and $150,000 is the final violation, which would resolve all the outstanding claims. So as soon as we receive that, I'll give the board an update, but that's where we stand today. If there's any questions, happy to answer them.
Thank you. We've talked about it before, but does anyone have any other questions regarding it? Okay, thank you, Matt. Marty, strategics? Deborah, strategic? First one.
So we had a request from United Way. I included their letter of request in the packet. This is for their 211 system that United Way in Marion County traditionally pays for out of their proceeds. 211 is like 911 for nonprofit social services, and basically it's where our citizens will call up 211 and get information about nonprofit services, education, housing, behavioral health, substance use disorder services, food, health care. If someone has needs for utilities, they call. Unexpectedly, United Way did not have as much revenue this year as they anticipated. And so one of the shortfalls is that they're asking various organizations in Marion County, including the hospital district, for a contribution to continue 211, at least for this year. They need a total of $200,000. However, United Way has some of their own funds. However, they're asking for $30,000 from the Marion County Hospital District. And I have some questions or concerns about 211 for Marion County, only because we need the information that's fed into 211 entails quite a bit of training for the 211 operators. And so there hasn't been enough time for me to evaluate, particularly the area I'm interested in. If someone calls 211 for behavioral health or substance use disorder services, how are they being led to their decisions as to who to call? Because we have lots of providers here. They might lead them to a methadone clinic. I mean, I have no idea what the decision tree looks like or how up to date it is, or if they're utilizing free services instead of services where they have to pay. So what I'm asking the board, I've really dug into this, but I don't have enough information to say what the long-term need is. But I would be remiss if I didn't at least ask the board or recommend that we invest the $30,000 if our partners are going to also to continue 211. So I have this year to evaluate the efficacy of the program, because 211 is nationwide and statewide, and in the state, there's, I don't know if there's more than one county that is not utilizing
Yeah,
211.
this is, you probably didn't, I didn't show, this is not a unique problem to Marion County. This 211 underfunding really is a statewide problem. It's a statute that requires 211, but state government doesn't allocate any funds to support it. United Way's been supported for countless years, but really it's not their core service, and the giving levels have declined, and so I guess they're reaching out, trying to find other stakeholders to take an interest in funding this. It truly, it's a countywide, benefit. But it's not unique to us. I think every county, I think we participate, United Way participates with 6 other different counties for this 211.
They participate, is this portion just for Marion County that they're
Yes.
asking?
Correct.
Okay. Michelle, do you have insight on this? Yeah.
Sorry.
Thank you for asking, Madam Chair. I don't have much more to add than what Mr. Branson has already provided the board. It is being evaluated, and the way Marion County is looking at it is through our Community Services Division. Those fundings to see if they can be utilized. They are definitely looking to provide a navigator, and they can pay for a navigator. So, but going back to the call tree, that's a really great question. So I do not know how that's done.
Thank you. Anybody else have any insight?
Assuming we make this funding, this dispatcher is provisioning only for Marion County? Or is it for statewide? Or how does it go?
The 211 that's outsourced to a third-party vendor, and I think
Call
actually
center.
the call center in Broward, but when you call in, it identifies where you're calling from. So from that identifies, who to call, how to direct the call, and what resources are available. I think the number that, don't hold me to this, but I think the number is right around 10,000 calls. What, you have the number there, Kurt?
Like 24,000 calls,
24,000, thank you, 24,000 calls. So
just for Marion County.
A year.
Yes.
But I agree with Kurt, that I'm very concerned about that training that's actually going to direct all these calls to the right location. I mean, it would be
Yes, absolutely.
So Dr. Ron, what happens is when, I do know when the person calls in, that the operator gets it, they identify what that need is, they look at the service provider, and the service provider keeps their contact information and what those dollars are available, so they can then direct the individual who has the need to the service provider who can provide the service. So it's a constant update that service providers have to give to the Broward County call center that, of course, the person dialing 211, they don't know they're talking to Broward County because it is very specific to Marion County only. Does that help answer a little bit?
Yeah.
Yeah, and my concern is if we didn't provide some level of support, we might miss out on individuals, particularly for behavioral health and substance use disorder, that if citizens are used to making these phone calls and they're used to calling 211 for these social services, particularly behavioral health, then I'd be concerned that if the service went away and we didn't have an alternative, that it could jeopardize citizens. So that's why I would like, at least if we were to provide our portion of the contribution that's asked for, $30,000, that would give me time this year to completely evaluate how the operators are educated and how they make their decision tree for citizens.
What do we have in discretional, will it come under discretional funding?
Yes.
244,000.
244,000. Okay.
So I go ahead and move to allocate this $10,000 to you anyway, at least for this year, and then you can evaluate.
Ken?
The question is, how do we know that the number of people that actually call in follow up and that we're actually got a service, that we have some kind of accountability, other than say, we received the call, so we show that a call was here. We don't know if the call was used. And is the service really being provided? And then my other question was, are we looking at just a one-time funding to see how this goes, or is this going to be one of those yearly with probably a percentage increase to keep that kind of a task going? But accountability is what I want to know is, are we getting what we're supposed to be getting for what we're looking to get? Are we getting the end product? Are we getting people to where they really need to be versus we're just answering a call?
No, that's an excellent point. That's what I'm concerned about. We have the raw numbers for the calls, but we don't know the efficacy of it. And if the social service organizations actually, provide the service to the individual. But again, we do know that it's being utilized for calls, so this would give me an opportunity to go in and do that research.
Yeah, is there any way that somebody who's been working with this for years, somebody from them, who could come and really present exactly how this goes down? Because if you're also, and I don't know if they're looking at a list of saying, okay, this is the next group on our list that we'll send somebody to, and you just keep sending down versus this is the best place for you to be. I don't know how they're distributing what information.
When is their ask need to be fulfilled?
They need a commitment by June 1st.
Yeah.
From
Maybe
the partners.
clarification of how this functions.
Well, Kirk, at the meeting with the stakeholders, so there's been a couple of meetings, right? So all stakeholders have been in those meetings, talked about 211, and the outcome of those meetings is that, not speaking for the meetings I wasn't there, but was it stakeholders' opinion that this service was, I don't know if these were critical, but it was needed for our community?
I attended one.
Oh, you did, excuse me, I'm sorry.
I attended one, and one of the concerns, if it goes away currently, is that people are going to start calling 911 versus 211. And that's a big concern of everybody sitting at the table, from law enforcement to representatives of the hospital that were sitting in the room.
I'm just concerned about efficacy. And then we're getting at the call center, we tell them anything to do, but are they really utilizing it? And how's that functioning? I have no problem with the $30,000 giving it up. I think it's a great thing. But I think, like all our other things that we're giving money to, we have to have some accountability for what's going on. Otherwise, we have no idea. We're just selling out money.
Okay, well, I understood. I understand, I think everybody does. We have a motion on the table. So we need a second.
Yeah.
Oh,
No, I need to abstain. I'm on the board for United.
okay,
so.
all right. So we still have a quorum to abstain? Okay.
So I have a motion. Same thing to approve it.
For this year only. Is that correct, Ron? For
Yeah,
this
for
year?
1 year, and he's going to look at the efficacy of that. And try the next year.
Okay, you read it. We're good, finding the efficacy.
I'll second the conversation.
We have a second. Any now further discussion?
Dr. Marino's suggestion, and based on what Kurt said, we have till June, so we have 2 board members missing, 1 abstains, so maybe we can finish this one up next month, maybe get a little more information between now and next month.
Okay. Is everybody good with that? Okay. How do we? Motion.
I make a motion to table the motion.
We have a motion to table the motion till next meeting.
Right.
We have a second? All in favor?
Aye.
Motion passes. Okay. Thank you, Michelle, for that. Elected leadership challenge.
evening. So I have a couple of announcements pertaining to the Active Marion project. The first of which being that we are 1 month in to our 3rd annual Local Leaders Step Challenge. We have 6 teams that are fiercely competing right now. Ocala Police Department, Marion County School Board, the City of Ocala Mayor, the City of Bellevue Mayor, Marion County Sheriff's Office, and the Board of County Commissioners. Just a little history on this. A few years back, when we were at a public school board meeting, the board chair, Reverend Cummings, called out publicly all local officials and said, I challenge you all to a step challenge utilizing our app. It's been a lot of fun over the last several years. We do some fun little videos. So we are going to show you a video that our Ocala Mayor Ben did that is on our social media for the challenge. And this was a rebuttal to the Bellevue Mayor's video because she specifically called Ben out and said he is not going to win this year. So we're going to show you the video real quick.
How dare that Bellevue mayor call me out on the leadership step challenge through the Active Marion project. We are going to wipe the floor with them. What a great strategy to get the employees taking the stairs. We're going to train now and be ready for April 1st. We got this. Come on, guys. We're going to wipe the floor with that Bellevue mayor and get that horse back where it rightfully stands.
So these videos have become a huge part of our step challenge every year. We really appreciate the good sportsmanship and the people who pitch in. We also have a video that Dr. Bellett, Superintendent of Schools, did. Be sure, if you've not done so already, to be checking out our social media, following along with the fun of the step challenge. I will say Ben has been so supportive that he started a separate team called Healthy Ocala, and we have a bunch of people that jumped on that team for the community, so it's really amped up, no pun intended, over the last 30 days. The second announcement I have is, again, you guys know, everything that we do is very much collaboration and partnership. We created the Diabetes Consortium several years ago, bringing together a plethora of community partners so we could all be on the same page to combat diabetes with education, free education throughout the community. One of our partners is the health educator at University of Florida IFAS Extension, and that's the Institute of Food and Agriculture. I know sometimes people are unsure what IFAS is. And she came to us a couple months back and said, you guys, listen, I feel like not only your diabetes education classes and your consortium and everything you're doing, and that she's partnering with us on would be a great nomination for a national award, but also she partnered with us on our Eat Healthy, Be Active classes with the school bus drivers. The school system came to us several years ago and said, our bus drivers are failing DOT physicals, and we've been working with them ever since we've stopped going out this week. She submitted 2 proposals. Now, mind you, we are competing against 68 other extension offices within the state of Florida. We won first place for both. So we were very pleasantly surprised that both of those proposals won first place, both for our diabetes education classes and our Eat Healthy, Be Active classes. And now we're going on to compete at the national level. So it's really exciting that has occurred on behalf of the Active Marion project. And then lastly, we have some of our Q2 updates in the packet for you guys to review. As you can see, Crystal did a really great job of pulling all this together for us. Most of our goals are either on track, many of them have already been exceeded, and we're only halfway through the year. So I'll entertain any questions right now if you guys have any questions with regard to that Q2 update. We've got fans and CHP in the packet. There are no questions.
Thank you.
You're welcome.
So that finishes up strategic. Any old business? None? Hearing none, we are adjourned.